Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I Tell.
All right, my name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And friends, you are in the right place if you are thoroughly frustrated, if you're confused, if you're angry, if you're all of the above, and you don't know what the heck's going on with the real estate market, with the mortgage interest rates. What's happening? Is this a house of cards? Is it going to come tumbling down? What does the latest news mean? It's super confusing out there, guys. We do this each week. We're going to give you the tips, the tricks, the strategies, the inside information, and of course, the answers to all your questions so you can make better real estate and mortgage decisions for you and your family. Again, my name is Mark Eitel. This is the Mr. Mortgage Show. I am joined, as always, by my producer, Jen, who is standing by womaning the Anytime Hotline. If you have questions or comments and you want to get them on the air, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Or head on over to mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over via email. She'll read them on the air for you. But yeah, another crazy week of housing headlines and consumer debt headlines. One that really jumped out at me was consumer debt just eclipsed $17 trillion, $1 million. Remember Dr. Evil? $17 trillion in consumer debt. Man, that's mind-boggling to me. That's more than a lot of countries. It's crazy. Now, the lion's share of that are mortgages, credit cards, and car loans, which is no surprise, but just big number there. Another very interesting fact that was released this week, mortgage delinquencies, the second lowest month on record. Mind blown, right? Because everybody is talking about foreclosures. Get ready. All of this opportunity in the market, all of these foreclosures are coming. Well, where are they coming from? I don't understand. If mortgage delinquencies, which are the precursor to a default and a foreclosure, just recorded their second lowest month in history, well, it's unlikely that a big wave of foreclosures are coming to the market anytime soon and are going to negatively impact housing values. Because guys, as much as we're frustrated by where housing prices are, yes, it's super expensive to buy a house. Historically, never has it been this expensive. Either the actual dollar amount or the proportion of money that we're spending each month in relation to our income. It's never been more expensive to buy real estate, but supply and demand, not how you and I feel, that's what controls the price of anything. Tulip bulbs, toilet paper, hand sanitizer, and real estate. It's supply and demand. And where is the supply going to come from? A lot of people keep saying it's going to come from foreclosures. Well, here's one more data set that contradicts a big wave of foreclosures coming to the market. Now, the other place that supply can come from, well, a couple other places, but one are the builders, right? All of a sudden, builders can start building a bunch of new houses. And we're seeing building material prices down, which is a good thing. Builder sentiment just turned positive for the first time in almost a year, which is encouraging. But guys, if somebody ran out tomorrow and put a shovel in the ground, when is that house going to be ready to go to market? A year? 16 months? 2 years? Who knows? It doesn't just instantly appear. So that's very unlikely that builders are going to absorb the shortfall in supply. And then lastly, resales. And that's traditionally where the lion's share of home sales volume comes from. Well, there's this term out there, rate locked in by interest rate. A lot of people don't want to sell their house and go buy another house. They've got a super low interest rate, a load of equity, and they're okay. They're going to weather the storm. They're not going anywhere anytime soon. That's also putting an unusual amount of pressure on the supply side. So because of all that, right now there's still more demand than supply, and that's what's got these housing prices where they are. And until that changes, guys, they're not going down, and certainly not at a fast pace. So you might find this interesting. I just reposted a Facebook post from a little over a year ago where I shared a chart that shows the 4 components to any market, from boom to bust to boom again, and the 4 cycles of any market that we've got to go through, from undersupply to oversupply, etc. Just go to mrmortgageradio.com and click on that Facebook link, and it'll take you to the page. I think you'll find that interesting, and it's pretty clear to see where we are on that chart today, and it's just not lining up for a bust scenario anytime soon. And I shared that article because, guys, we were having these conversations on the air over a year ago. People were saying, I'm going to wait, prices are going to slide. I'm going to wait, prices are going to slide. Well, they haven't, and money's costing more now. So waiting was a double-edged sword for a lot of people. So that's why I shared that. Not because I'm, saying I'm right. I didn't write the article. I just found the data, found it interesting, checked it against the market facts, and thought it was worthy to share with the audience. So by no means am I celebrating any of this, because it's super frustrating for people right now, and I get it. But one thing I do want to share that's very, very different about this market than the housing boom that led to the Great Recession. Because if you guys have listened to the show for any amount of time, you know that I started in the business in 1999. And before that, grew up in my family's business, which were home builders and developers. So this is in my blood, my whole adult life. Actually, as a kid, I've got baby pictures of me dragging a hard hat and a hammer across the living room floor. But that's a whole nother story. So the difference I wanted to point out is, in the early 2000s, people didn't have all this equity. There is so much equity in the market right now that if the economy did take a downturn and somebody did get late on their mortgage payments and go into foreclosure, they could sell and make a profit. Guys, we didn't have that safety net built into the market last time, so people were sliding their keys across the table to the bank, and sometimes not just one set of keys, but 6 or 8 or 10 sets of keys, because they had over-leveraged and over-speculated. Those components of the market aren't there this time. The vast majority of people own their primary residence. Some people own a second property, which may be a second home or an Airbnb, but by and large, the demand in this market was driven by people looking to buy their primary residence, and there is so much equity in the market right now that we could absorb a bit of a downturn before people saw true losses. Now, that's not to say if we took a downturn and somebody bought yesterday, yeah, they might be in trouble if they borrowed 97% and things went down 5 or 10%, but there's no clear indication that that's going to happen. And I just wanted to point out that equity piece, because it is super, super important and super, super valuable, in the sense that it was not in the market last time. So there was no bailout strategy, if you will. There was no way out of it. People were going to have to either cut their prices significantly or ultimately lose their home, and they did just that. So I'm not sharing any of this to insinuate that the market is going to repeat itself, because the fundamentals are so very different, guys, and we talk about it all the time. But guys, you hear the music, you know what that means? Jen is jumping up and down back there saying, Mark, be quiet, we need to get into a break. Guys, we'll be right back after this very short break. We're going to dive into your questions. We'll deep dive some more of the data. Sit tight. We'll be back with more of the Mr. Mortgage Show. Howdy, folks. Hey, we believe that getting a mortgage on a trailer shouldn't be harder than wrestling an alligator. Shouldn't be harder than reeling in a largemouth bass with your left hand, or even opening a cold bottle of beer with your teeth. That's why we're all about those outside-the-box mortgage loans that cut right through the BS and offer you the flexibility that you need to make a manufactured home your very own. From single wides, double wides, and triple wides too, we've got the options you need to make it happen. We don't care how old the trailer is either. That's right, old single wides are fine with us as long as they're in good shape, and land leases are okay too. Yep, you ain't got to own the dirt. Folks, home prices are out of control, and trailer living makes a lot of sense for a lot of people. We are here and happy to help. Check out FloridaManFunding.com. That's right, FloridaManFunding.com for all your manufactured home mortgage needs. FloridaManFunding.com. Brought to you by Mark Itel, NMLS 1929005.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Itel, and you are tuned in to the Mr. Mortgage Show. Guys, we are going to start diving right into your questions. Hey, Jen, are you ready back there? Do we have any questions?
We've got questions, and they want answers, Mark.
Okay, well, let's give them some answers. Go ahead and throw question number 1 my way. You ready?
Joni has this question. I'm buying a house and got my approval from my current mortgage company. The fees they are quoting seem very high. How do I know what charges are negotiable? I heard you offering to review a quote.
Hey, Joni, thank you for that, and thank you for paying attention during the show. Yes, fee sheet review, we are happy to do. Ooh, I just did a rhyme there. Fee sheet review, we are happy to do for you. Oh, my God, it continues. Somebody stop him. This is what happens, guys, when I'm 2 cups of coffee in before we even start the show. Joni, yes, I'm happy to review that fee sheet for you. Go to MrMortgageRadio.com, click on that fee sheet review button. I'll be happy to take a look at it. The instructions are there how to get it over to me. But to answer your question on the air, you'll see it should be categorized as items you can shop for. And those are things like the title company or the title attorney's fees. I'm not sure where you're located. Some states are attorney states, some are title company states. Some of those fees are negotiable. On the lender side, which are often the bigger fees, things like origination points, discount points, those type of fees, you can negotiate. It might affect your interest rate because the lender gets paid for loaning you money 2 ways. They can charge the fees, right? The origination points or the discount points, and that has a tendency to affect the rate, or they can charge you a slightly higher interest rate and just collect that profit over time. So this is a super interesting point that I want to share. But before we get to that interesting part, I hope this answers your question. So I would start there. And guys, if you're out there scratching your head, points are 1% of the loan amount. So if you're borrowing $250,000 and you're paying an origination point, that means you're paying the brokerage or the bank 1% of the loan to facilitate the transaction. If you're paying a discount point, you're likely buying down the rate. So just throwing that out there. But those are big places to start. But shoot me over that fee sheet and I'll go through it with you, and I'll point out some places where you might have an opportunity to renegotiate. And who knows, we might be able to offer you a better deal from the beginning, and I'll be happy to do that as well. And guys, if you're wondering how that works, so we launched this for everybody. We used to just do it if someone requested, but right now today, everybody is super focused on interest rate and fees, as you should be. But when the market was so low, the difference between 3.125 or 3.375, the average person wasn't computing that there was enough of a difference to shop. They were just thrilled to get that low rate. Well, in this environment, people are scrutinizing every line item, again, as you should. So we decided to open that up for everybody. So Fee Sheet Review is a service. I think we have a website, feesheetreview.com, but it's all at MrMortgageRadio.com, and you click on that Fee Sheet Review icon or button, and it'll take you to the instructional video, but happy to do it for you. Now on to the really interesting thing, or at least I find it interesting. We're so trained as consumers that the lowest interest rate has to be the best option. And oftentimes it is, but the lowest interest rate can also be the most expensive option. And what I mean by that is there are usually fees associated with, getting a lower rate or buying a rate down or paying points on the front so the lender will lower that rate. And the best visual representation, because anybody who's been with me on this journey with the radio show for any length of time know that my very simplistic Florida hillbilly mind works in pictures. And there was a CarMax commercial, and I think CarMax was nationwide. I think they're still around. I'm not sure. It's been a while since I bought a used car. But anyway, CarMax had this commercial where they had this long balloon. Think of a larger version of the balloon that the clowns make balloon animals out of. And the announcer was holding this balloon, and on one end of the balloon was written fees, and on the other end was written price. Well, for the Mr. Mortgage Show analogy, change price to interest rate. And the gentleman would squeeze down on one end of the balloon and the other end would get larger. So if he squeezed down on fees in the CarMax commercial, price, or in our analogy, interest rate would get bigger. But if he squeezed down on the interest rate or the price side, the fees would get higher. And that was their way of exemplifying how the normal car dealer does things, right? They're squeezing one end or another. Well, in the world of finance, it's not much different. There are fees associated with every interest rate, and the lower the interest rate, the higher the fees are associated. And sometimes, guys, it makes sense to pay a slightly higher interest rate and get a credit back from the lender because you can use that lender credit to offset some of your closing costs and other costs of closing that loan. So it's an interesting idea that we default to the smallest number has to be the best choice, not realizing that sometimes the smaller number increases a number somewhere else in that transaction. And that's what the whole fee sheet review thing is about. It's about us providing you total transparency, whether it's our fee sheet or someone else's. And I love doing it because one of three things happen. And if you listen to the show, you hear me say it all the time. We'll either congratulate you on getting an awesome deal, which is great because then you can exhale and just move forward. You got a good deal. The second thing that may happen is we could point out some places in there that you could renegotiate, and we will highlight it for you. This, at this interest rate, maybe this is a high fee. And then thirdly, and I always love when this happens. It doesn't happen always though, but I do love it when it does. We'll offer you a much more competitive option. So anyway, I appreciate that. I didn't mean to turn that answer into a commercial, but that's something that we've been doing, and we've been doing it successfully. People are super happy with it. And guys, we're only able to beat about half the deals out there. There's some really competitive quotes being thrown around out there. So, but we're having a lot of fun doing that. We're beating quotes when we can and congratulating other people on getting good quotes. And it's always our goal to give you the best possible mortgage option with rate and fees all being taken into consideration. So I appreciate that question, Joni, and I'm happy to jump in and take a look at it for you. But hey, guys, you hear the music. You know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the show. Let me tell you a little story about a man named Jed. Well, this is not a story about Jed, but it is a story about Mary. Mary is an awesome single mom who's been raising her daughter in a 1-bedroom, 1-bath apartment for the last 11 years. That's right, 1 bedroom and 1 bath. Hey, they've made the best of it. They've got bunk beds in there and it's worked. But her daughter's now a teenager and it's becoming a challenge, especially sharing that bathroom. She decided to jump in and become a homeowner. We got her approved with an FHA loan. That's right, I said it, FHA. Hey, if your agent's telling you FHA and VA loans are not getting accepted, you are working with the wrong agent. Contact me and I'll get you in touch with a really great agent. Hey, but back to Mary. She jumped in and she is now a proud homeowner. They have their own bedrooms, but more importantly, their own baths. They couldn't be happier. Guys, if you'd like to learn more, check out MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are tuned into the Mr. Mortgage Show. And if you've got questions or comments and you want them on the air, call or text 855-462-7292. Share those thoughts and questions with us, guys. Call or text 855-462-7292. That's 855-462-7292. That's the Anytime hotline, and Jen will get you on the air. If you want to send us an email instead, just visit MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over that way. Hey, but speaking of questions, and Jen, we've had some good ones so far, so let's keep this party going here. Let me throw it over to Jen for another question.
Pauline sent us this one. We're in a tough spot and need a debt consolidation mortgage. I've been researching online and we have enough equity, but our debt ratio is too high. But if we pay off our cars and credit cards, we would meet the requirements. Is there any way to make that work?
Hey, that's a great question. You, Pauline, are stuck in the old catch-22, right? So you make enough money and you've got enough equity, but your debt-to-income ratio exceeds the requirements because of all the debt. But you want to pay that debt off. So once you close and pay off all that debt, you would meet the requirements. So ultimate catch-22. Here's the good news. We can pay that off at closing for you and pull it right out of your debt-to-income ratio now. And you would meet the requirements because we're using the lower number, right? The after the debt's been paid off number in your debt calculation. So I hope you find some encouragement in this answer because it's doable. We do it with the REC refi. The REC refi is the REC, reduce, eliminate, and consolidate. And it's designed exactly for this purpose, right? We're paying your debt off. And the cool thing is we can underwrite you as if it was already paid off. But the caveat is if we do it that way, we've got to pay it off at the closing table. Meaning if it's a Discover card, 2 car payments, and a Visa that need to be paid off to make your ratios work, we actually take part of the proceeds right at the closing table and write a check to Discover, one to Visa, and one to each of the car payment companies, and then your debts are paid off. You're done. No more monthly payments on those. But the trick is you can't go out there and run them back up, or you'll be right back at the closing table in the future. So, but brilliant question, and it's doable, absolutely doable. It's paid at closing, and it's part of the REC, the REC refinance. And if you have any questions or if you want to get that process started, just give me a call, 855-462-7292. We'll be happy to jump in and get that rolling for you. But I appreciate it. That was a great question. Hey, Jen, throw me another one.
Caitlin is asking, I've heard you mention a strategic refinance if rates drop in the future. Is this the same as a streamline with no documents required? Thanks.
Wow, that's another great question. So the streamline refi, let's start there. So they're different, right? The strategic refi and the streamline. The strategic refi, I guess I'll start with that. That was your first question, is something that we developed when rates hit 7 last summer and everybody was wanting to buy a house but super concerned that they didn't want to have to refinance in 6 months. Well, guys, the rates haven't gotten low enough to want to refinance, but what we did back then was we put a program in place where we would be able to reduce some of the costs associated with doing a refinance and try to make it as affordable as possible. But it's not a quote-unquote streamline refi. Those are completely different animals, and I'll explain those in a second. But the strategic refi is still going to require documentation. You know, it's going to be like any other refinance transaction with the exception that we're going to do our very best to put a reduced fee package in place to help it make financial sense if you want to lower the rate. So that's what the strategic refi is all about. Now, the streamline refi in the world of FHA and VA are amazing programs because their only concern is to lower the interest rate. There's very, very little documentation. There's no appraisal. There's very few documents required. The goal is just to simply reset the interest rate at current and lower your monthly payment. So the VA world, it's called an IRRL, Interest Rate Reduction Refinance Loan, IRRRL. Why do all these acronyms end up having me sound like a SEAL? But anyway, the IRRL is the VA's version of the streamline refi. And then in the FHA world, it's just called a streamline refinance. So I hope that answers your question. I appreciate it. Hey, Jen, I'm going to toss it back to you. What do you have?
Martin is asking, Is there a downside to getting an equity line and not using it? Are there any inactivity fees?
Hey, Martin, that's a brilliant question, my man. I don't think anybody has asked me that before. So kudos to you. That is a wonderful question. No inactivity fees on an equity line of credit that I'm aware of, certainly not on the ones that we facilitate. So brilliant, brilliant question. Now, is there a downside to getting it? In my opinion, no, because I would much rather have it and not need it than need it and not have it. And what I mean by that is, let's say you're worried about the future, and a lot of people are. There's a lot of economic uncertainty in this economy. And let's say you're right and things in your personal world take a downturn. You lose your job, you miss some payments. You could really use some of that equity to get through the skinny times. Well, if you wait until some of those things happen, you may no longer qualify for an equity line, credit score wise, payment history wise. If the housing market takes a significant downturn, you might not have enough equity. So getting it now and putting it on the shelf, and wrapping it in a, in case of emergency break glass type box, I think is a brilliant, brilliant idea. It's like packing a parachute before you get on the plane. It's much easier to do it, and you've got it if you need it. So I think that's a brilliant idea, and I think there's a lot of merit to that strategy. Now, one thing I do want to point out that a lot of people are unaware of is if things significantly change from a value point of view, right? Let's say the housing market takes a downturn. The banks can reduce the available credit line because it's based on equity, or in some cases, close them out completely. So in that instance, if you had one that you didn't use and it was sitting out there with a zero balance, and then suddenly there was a credit crunch and the bank said, okay, we want to, recall these, if you will, or close them or reduce them, and you need it then, that might pose a challenge. And fun fact, we saw a lot of that happen during the Great Recession. People's equity positions were greatly reduced as the market started to slide. And because of that, the banks reduced the lines, or in some instances, just capped them, closed them, and converted them to a 20-year loan. The equity drawdown period is now expired. You don't have any more access to the equity, and we want you to repay this loan. So we did see that. That's a downside, but it's not negatively impacting you from a credit or cost standpoint. So, but that, my man, is a brilliant question. And guys, with what's going on right now and all the economic uncertainty, we're seeing a lot of people kind of follow Martin's lead down that, path of a HELOC just in case I need it in the future, which is never a bad idea. But anyway, guys, you hear the music. You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards, and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at mrmortgageradio.com. That's mrmortgageradio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at mrmortgageradio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. Guys, call us, text us, strap your question to a carrier pigeon and shoot them our direction. If you got questions or comments, give us a call. Shoot us a text to 855-462-7292. That's 462-7292. That is the Anytime hotline. I get rolling there and I feel like I'm one of those auctioneers. I don't know if I'm saying that too quickly. 855-462-7292. That's the Anytime hotline. Affectionately named that because it rings here when we're in the studio, right here live, and it pushes to my office when we're not. So you can get us just about any time on that number, or shoot us an email, and you can find the email by going to mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, type away and hit send, and Jen will read your question on the air. But man, we've had some great questions so far, and let's keep those questions coming. You ready, Jen? Okay, what do you have?
Sam sent us this. Can I use the cash from a refinance as a down payment for a rental property? Is there a waiting period?
Sorry about that. I'm so eager to answer. Hey, Sam, brilliant question, my man. And yes, you can. You can use an equity line or a cash out refi to pull some equity out to go buy another property, in your instance, an investment property. So equity extraction is a suitable source of a down payment. And if you use the landlord loan that we talk about, your debt to income doesn't even come into calculation if the income on the property you're buying supports the debt. That's all we're looking at. Boom, you're a landlord. And guys, we just did this exact scenario. I guess let me share this win because it's pretty cool. They owned a property down in Hollywood that they sold and paid their home off in Stewart. Loved it. Everything's going well. They decide, you know what? We want to buy some investment property. Ultimately, we would like to retire up north, which I know flies contrary to a lot of us because people retire down here. But it was super interesting. So what they did, they put an equity line on their primary home, and we pulled enough cash out of that for the down payment requirement on what will ultimately down the road will become their retirement home. But in the meantime, they're going to use it as an investment property. So equity line extracted the money, landlord loan on the other end, no personal income documentation required. We reviewed their credit. We reviewed their asset positions. We reviewed their liquidity. Boom, they were done. So, Sam, that's certainly doable. And we just closed a transaction this week that went exactly like that. So it's super cool idea. And a lot of people have a ton of newfound wealth in the form of equity, and they're getting creative on how to put that to work instead of just leaving it dormant in the house. And guys, I'm not a gambler. If you want to leave it dormant in the house for a time down the road, I'm all for it. But it's interesting to see people using it to leverage other properties with, and I find that fascinating. And fun fact, in that scenario I just shared, the rental income on the property they're purchasing, they just closed on Tuesday. It's going to pay the equity line on their primary house in Stewart, as well as all the expenses on the investment house. So it's a win-win for them. But brilliant question and fantastic strategy in this market where people have so much equity. All right, Jen, do you have another one?
Zaina sent us this text. Does it make more sense to buy down the rate or take an adjustable rate? They seem very similar. Thanks.
Hey, that is a good question and a very cool name. Did I hear that correctly? Zaina? Wow, that's a super cool name, Zaina. So, yeah, thank you for that. It's confusing because an adjustable rate mortgage versus a rate buy down does seem very similar if you're comparing to the 3-2-1 or the 2-1 buy down, because those payments adjust upward every year. So in the case of a 3-2-1 buy down, which is the one that's most commonly spoken about right now, everybody's really excited about that. You can buy the interest rate. Let's say 6.5% is the rate of the day. With a 3-2-1 buy down for the first year, your interest rate is 3.5%. Well, that's what gets everybody super excited. Then the second year, it's 4.5%. The third year, 5.5%. And then it's 6.5% from the fourth year till the end of the loan. An adjustable rate mortgage starts at a lower rate and stays fixed for a period of time. So you'll see the term 3-1 ARM, 3/1 adjustable rate mortgage, or 5-1 ARM, or 7 or 10-1 ARM. Those are the most popular out there. They all act the same. It's fixed for the first number. So for the first 3 years, the 3-year ARM is the lower interest rate, and then it adjusts every year, sometimes every 6 months, but most commonly every year. That's the second number, the 1, and it adjusts to market. So a 3-1 ARM or 5-1 ARM is awesome if you're in a long-term descending interest rate environment, because that means rates are likely to adjust down. And we did see some of that back in the 2008 time period. People bought with 5-1 ARMs and their rate went down for quite some time, and then they paid their property off. So an ARM's not always a bad thing. I'm super conservative. I like a fixed payment. That's just me. I like the shortest possible term and the lowest possible fixed interest rate. So the 3-2-1 ARM steps from 3% below market back to market over the first 3 years. And then the adjustable rate mortgage stays fixed for that first number, 3-1, 5-1, etc. So to stay fixed for 3 or 5 or 7 years. And then it adjusts every year to market conditions. And you'll hear the term margin and index. So the index could be, for the longest time, it was the cost of funds index. And you go to the wallstreetjournal.com or cnbc.com and you type in COFI index, and it would show you what the rate was. And the margin is what you add to that cost of funds index, or whatever the index is with the ARM. That's how the new rate is determined. It stays fixed for a period of time and adjusts. So with the ARM, it's adjusting at minimum every year, sometimes every 6 months, but at minimum every year. With the 3-2-1 buy down, it adjusts for the first 3 years and then remains fixed for the life of the loan thereafter. Now, the one I'm most excited about, it's less sexy on the front end because it's a permanent buy down, so you can't buy it down as far for the same money in most instances. So let's say you use that 6.5%, you might only buy it down to 5.5 or 5.25. But the cool thing is it stays 5.25 for the life of the loan. It never adjusts. It always is the lower interest rate. And guys, if rates go back to the 4s and you've got a rate in the 5s, you can refinance if you want. But what if they don't? What if rates stay where they are for 10 years? Or what if they go up from here a little bit? You, with the permanent rate buy down, you're winning. You win the game. You started at 5.25, to use that example that I just shared, and you stayed there for a long time. And that's a super, super cool option versus the adjustable rate. In an adjustable rate mortgage in an increasing interest rate environment, your rate and your payments are going to go up. With the 3-2-1 buy down strategy, you're going to start super low, but your payments are going to go up over the first 3 years, and then they're going to reach a plateau and stay there for the remaining 27 years. So I hope that helps explain it. They act very similar. The goal of both is to give you a lower payment in the beginning and make it more palatable, if you will. The challenge that I see with that strategy is a lot of people have amnesia and they forget that payment's going to adjust, and they go out and buy a boat or a jet ski or an RV, and now they've got a lot of bills and that mortgage payment is going up. And I'm not a fan of that. I'm a fan of budgeting, buying your house, and paying it off as quickly as you can, as comfortably as you can. But I appreciate that question. I know it's super confusing. And if anybody out there wants to talk more about it, you know how to get us. Just give us a call, shoot us a text, 855-462-7292. I'll jump on the phone with you and we'll figure it out. But guys, you hear the music? We'll be back right after this short break with more of the Mr. Mortgage Show. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at mrmortgageradio.com. That's mrmortgageradio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at mrmortgageradio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are locked and loaded right here with us on the Mr. Mortgage Show. Guys, thank you so much for spending a little bit of your day with us. We greatly appreciate your participation. And if you want to participate, shoot us your questions or your comments. You can call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. If you prefer to shoot us an email, check out mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions in that way. And man, we've had some great ones so far. You guys are paying attention. You are on it. The smartest audience of any real estate mortgage show on the air today exists right here on the Mr. Mortgage Show, and I'm super excited to be with you. Hey, Jen, let's keep the questions coming. Do you have another one? Okay, what do you have?
This is from Cecilia. Can I be a co-signer on a mortgage to help my son? I don't intend on living with him. I don't blame you, Cecilia.
Sorry, that one caught me off guard. Very well done, Jen. Very well done. Yes, Cecilia, you will be classified as a non-occupying co-borrower. So you don't have to move into the house. You don't have to physically be living there for it to be his primary, and you be able to help him by co-signing or being what we call in the industry a non-occupying co-borrower. We're going to take both your incomes, both your debt loads, and both your credit scores and qualify you together. We do it all the time. It's a brilliant, brilliant way for parents to help their children get into their first house. Gifting funds is another strategy that's used often. You can, if you wanted to, and I'm not suggesting you do, and I'm not suggesting that he needs the help financially, but you would be able to gift him funds for either a down payment or the closing costs and be a non-occupying co-borrower. So lots of ways to make that work, and we're seeing a lot of parents do that. And one fun fact, I'm trying to remember, I think it was Martin. I had a question. Martin, I might have this wrong. If I've got your name wrong, I'm sorry. I'm running out of steam. But somebody asked a question a little earlier about using an equity line a cash out refinance as the source of a down payment for another property. And then I shared the story about my friend who just did the very same thing with an equity line. Well, Cecilia, you could do the same. If you own your primary now, you could pull money out of it to gift to your son, and that would work as well. So a lot of strategies around parents helping their children get into that first home. And a lot of parents see the value in getting their children into that first home. And I told this story one time on the air. It's been a while, but there's a fairly wealthy family, and over the years we've done a lot of transactions with them. Truly blessed to have met these people. They're super, super nice people, but they ended up helping their both grandchildren, buy their own homes. And the reason they did that was because they wanted the grandkids rather, to have the equity when they needed it, because they didn't want to have to write checks for the rest of everybody's lives, because they're not going to be around forever. And their children, their grandchildren's parents, are going to inherit a bunch of money, and they've not demonstrated the ability to manage money well. So the grandparents put their heads together and said, hey, if our grandkids are going to stand a chance, we got to get them into some real estate here. So they build the foundation of equity. So I shared that story once before. But Cecilia, brilliant, brilliant question. Let's keep them rolling. Jen, do you have another one?
Adam sent an email. How hard is it to get a mortgage on a fixer-upper? If I move in after the renovation, can I get a normal mortgage?
Hey, Adam, that's a great question, my man. It depends on what level of fixer-upper, right? Is it habitable and you just want to remodel it? In that case, you can just get a regular mortgage. Does it need some structural repairs, or are there severe deficiencies with the property? In those instances, there are some loans like the FHA 203K. There are fixer-upper loans where they'll loan you some of the money to do the repairs. Those loans usually have a little bit of a higher interest rate. And then I say worst case, it's not a bad option, but there is a cost of opportunity with what's called a hard money loan or a private lender. Those often carry the highest interest rate. That may be an option, but it sounds like if you're trying to buy a home that's ultimately going to become your primary residence, that the best route would be going the normal mortgage route. And I would need a little more information to adequately answer that question, and it's all going to be predicated on what repairs need to be done. Because if it's habitable now, then you could just buy it with a normal mortgage. But man, brilliant question. I appreciate that. And congratulations on finding that opportunity, because we are seeing people look to the homes that need a little work right now in this market and finding opportunity there. So great question. Hey, Jen, what else do you have?
Rob sent us this. I'm supposed to get a large bonus at the end of September. I was going to wait to buy until then, but I found the perfect house. Can I refinance in October and lower my loan amount, or is that too soon?
Okay. I think I understand the question. So you want to take this big bonus and put it down on the house so you have a lower loan amount and then a lower mortgage payment. So if you buy the house now, you're asking, could you refinance soon and pay down the mortgage as part of the refinance? If that's the case, and I might not understand the question as you intended, but that's what I got from your question. If that's the case, you don't need to refinance. You can do what's called a recast. You can request a recast, which allows you to pay a lump sum towards the loan. They'll reduce the principal by that amount and then reset the loan essentially. So your payment's going to come down, and your loan is going to be amortized based on the new balance. So it's going to reduce your payment. And if that's your goal, to have a lower loan amount, you don't have to do a refinance to do that. You do what's called a recast. It's CAST, recast. And it's essentially a reset. And oftentimes now you're going to need to make everybody aware that that's your intention, because not all loans can be recast, but it's not a difficult procedure if everybody's aware of the goal up front. Because the other thing that does is if you just pay a big lump sum of money, it just shortens your term. It doesn't reduce your payment. But in the case of a recast, it'll lower your loan amount and reduce your payment. But brilliant question. Hey, let's see if we can squeeze in another one. And hey, Rob, if you need more info about that, just hit me up. Go ahead, Jen.
Aaron is asking, can I buy a rental property with a VA loan? I have a regular mortgage on my current house. Thanks.
Okay, Aaron, this is another interesting question. I need a little more info. You can use a VA loan to buy a 1 through 4 unit property, and if you're going to occupy one of them. So you can't use your VA loan just to go out and buy a rental unit and then keep your current primary. If that's the case, then that's highly unlikely. But if you're going to keep your current house, rent it out, and then go buy a property that's a duplex, triplex, or quad, you could move into one of those and rent the other 3 out and use your VA entitlement to buy that income-producing property as a primary residence. I hope that helps. I don't know that I completely understand that question, but I hope that helps. Buying an investment property with the VA loan is not likely. Buying a property that produces income that's going to be your primary can be done, and we do it all the time. Brilliant question, my man. Hey guys, you hear the music? You know what that means? Oh man, another week of the Mr. Mortgage Show has flown by. Where does the time go? Hey guys, if you need us when we're not on the air, check out MrMortgageRadio.com. That's MrMortgageRadio.com. All our contact info's there. We'll be happy to talk with you, answer any questions that you have. We're here. We're happy to help. Check out MrMortgageRadio.com. Otherwise, have an amazing week. We'll see you next week right here. Same time, same station.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.
Have you recently gotten a mortgage approval and now you're wondering, how do you know if it's a good deal? I mean, the wrong decision can cost tens of thousands of dollars in fees and interest rate. Is any of this negotiable? Is this a good rate? Guys, it's Mark Eitel, host of the Mr. Mortgage Show, and we are happy at no cost or obligation to you to take a look at that fee sheet for you. We'll go line by line through it, and one of three things will happen. One, we may congratulate you on getting an awesome deal, and then you can exhale and move forward knowing you did great. Or two, we may be able to point out some places in that fee sheet that you can go back and renegotiate a better deal with your current lender. Or three, and guys, this one's my favorite, we may be able to offer you even a better deal, saving you in fees or interest rate or both. Guys, there's no obligation. Just go to MrMortgageRadio.com. That's MrMortgageRadio.com. Click on that fee sheet review icon and we'll do the rest. It's Mark Eitel, NMLS 1929005.